You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment and capital gains deferral expert, Brett Swartz. Brett is the president of Capital Gains Tax Solutions, LLC, located in Sacramento, California. Together with his team and in partnership with the estate planning team, Brett provides trustee services which helps real estate and business owners gain tax deferral, freedom, liquidity, and diversification with their funds so they can create and preserve more wealth. Brett has been a licensed California real estate broker since 2006 and has been involved in over $70 million in closed commercial real estate brokerage transactions. He has brokered numerous successful 1031 exchanges and has a vast amount of knowledge and experience to share with sophisticated property and business owners. As a trustee, Brett is passionate about educating his clients about capital gains tax deferral with a deferred sales trust, how they can divest from real estate investments without a 1031 exchange, and then invest back into and back out of real estate at their own timing, all capital gains tax deferred. Beside his professional career, he is also an active commercial real estate investor and holds interest in multifamily, retail, medical office, and mixed-use properties. And so, guys, in today's show, we're going to dive deep and uncover the intimate details of this little-known capital gains tax deferral solution, the Deferred Sales Trust, which offers an attractive and flexible tax deferral alternative to the commonly used 1031 exchange. In addition, a properly implemented Deferred Sales Trust can dramatically decrease or eliminate the capital gains taxes that would otherwise be recognized in the year of the sale. And what I've personally found after being involved in hundreds of real estate transactions, both from the perspective of a buyer and of a seller, is that one of the biggest concerns that sellers face when they start considering letting go of one of their real estate investments is a significant capital gains exposure that might come as a result of the sale. In fact, I've seen firsthand many situations where owners of the investment property feel somewhat trapped between a rock and a hard place. You know, they really want to sell, but yet they're not really willing to take the capital gains hit that's going to come along with it, or that might come along with it. And so in today's show, we're going to go into detail on how this deferred sales trust might just be the miracle alternative solution to help you keep more of that wealth in your pocket when entering into a sale of a highly appreciated asset. And so, guys, I'm really looking forward to digging in with Brett here today. But before we get started, here's a quick word from our show sponsor, Sunrise Capital Investors. Hey guys, Kevin Buck here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. All right, ladies and gents, it's my honor to welcome Brett Swartz to the show. Brett, how you doing today, my friend?
I'm doing just fine, Kevin. Great to meet you over the Zoom webcam.
Yes, absolutely. I've been looking forward to this call. I know, Brett, you've been a longtime listener of the show, and you reached out to me a few weeks ago about this topic of a deferred sales trust. So I'm excited to have you on the show to dig deep. Obviously, I'm all about adding value to the audience. I know that you feel the same way. You love giving back. You love helping others. And this topic, I think, is going to resonate with a ton of our listeners that are out there that own real estate today. So I'm excited to dive deep into this deferred sales trust, understand what it is and how we can implement it into our business. But before we get into the meat and potatoes, Brett, if you would, maybe take a few minutes and just tell our listeners a little bit more about your background and how you got into this business.
Absolutely. Thanks, Kevin. Yeah. So I originally grew up in the Bay Area with my dad building in single-family development homes in the hills of Mission, San Jose. And so I kind of learned the sticks and bricks of real estate and cash flow rentals from when I was really, really young. Went to college and studied business, and also decided to dive into real estate as a career. And I started as an internship at Marcus and Millichap when I was still in college, and got licensed and got trained, and became a full-time commercial real estate agent selling apartment buildings. And that was in about 2006. And from there, just grew my career and learned how to underwrite properties, how to invest in properties, and really how to try to add value every day in a very competitive marketplace to be a young broker, especially when the marketplace, dropped like it did in 2008, 9, and 10. And it was challenging to do a lot of deals. So learn through the fire, I would say, and it made me better because of it. And also made me think outside the box and be more creative with how to actually win business and help clients out when they're faced such as things as capital gains tax.
Mm-hmm. So that's quite interesting. And I want to dive into the capital gains side of it. But you got started in 2006. And so it probably took you a year or so to get rolling in your business, right? I mean, you were an intern at first. And then yes. 2007, 2008 comes rolling around, right? So,
yes.
So the freight train has an immediate stop, right? You hit the brick wall.
Exactly right. So I have 2 degrees and a minor, and I was playing basketball in college. I actually didn't graduate until May of 2007, but I was still working at Marcus and Millichap the whole year and got licensed. And so by the time you officially allow you on the phones after training, which is many months, I was just getting going with my database and calling and underwriting properties, and everything kind of came to a screeching halt. So yes, it was a challenge, but again, it helped me learn through the fire.
Real quick, how'd you push through that mentally? How'd you push through that challenging time? I mean, you didn't know any different at that point, right? I mean, you were brand new to the business, and how'd you get through that very challenging time and stick with that? I mean, that industry. I mean, that career choice of yours.
Sure. All my other friends would tell me to go get a real job, and it was tough because it was 100% commission, no benefits, sure. no safety net there. I just love the business, everything a part of it, the mentors I have, the training I had at the company, what I was learning. The best part was meeting with clients and hearing their stories and seeing that these folks are not what you would think that the top 3% of wealth in America owns commercial real estate would be. Humble, hardworking, creative, gritty folks. And I just love hearing their stories and growing and learning and I just a passion for the business, I would say. And I, going to college, I didn't know I was going to be in sales or in consulting or selling real estate. You study certain things and you think you might find a job somewhere, but it wasn't until I was in full time that I knew this is what I wanted to do. And I would do whatever it would take to stay in the business and to grow.
Yeah, I'd have to say I agree with you. That's one of my favorite parts of this business is meeting the very humble folks that are in the real estate industry, the owners, the operators, the ones that drive the beat a pickup truck that are worth $50 million and have probably got a car that's worth $500, right?
Yeah, exactly right.
Exactly
right. There's nothing more inspiring than seeing that, and then seeing how they care for their communities and how they care for their tenants and they care for their properties. Absolutely. And they're providing a needed service, such a needed service in especially California, where it's tough to build and it's tough to make sense of a lot of value here. So it's really inspiring. I guess that's the biggest thing. Good, strong mentors, and then just inspirational clients.
Yeah, fantastic. Well, let's get on to the topic of discussion, which is deferred sales trust. That's what we're here to talk about today. And I know that we're going to be, we've only got a set amount of time, so I want to make sure that we cover all the bases here and make sure that our listeners have a very firm understanding of what a deferred sales trust is and also how they might be able to apply it to their own business or whenever they are looking to sell a property. So for those that aren't familiar with it, Brett, take a few minutes and tell us what a deferred sales trust is. Okay, give us a definition.
Sure. Yeah, so a deferred sales trust is just a manufactured installment note. So it'd be better known as a seller carryback that your clients and listeners probably know about, or at least their brokers and CPAs do. So the foundation is IRC 453, which again is just seller carryback law. The deferred sales trust itself is just a made-up name. It was made up by the tax attorney who created the structure along with my business partner and founder, Robert Binkley, who also made the structure 22 years ago. So just a manufactured installment note, 1920s tax law, CPAs, everyone knows about it. The key is just how you apply the law, and that's where our tax attorneys are experts, and they've created a niche for this trademark proprietary deferred sales trust.
Okay. Give us an idea of what it looks like in a typical sales transaction, how one might actually utilize this area of the tax code to benefit them during a sale.
Well, the first thing to understand is constructive receipt, okay? And so constructive receipt, it happens when either escrow or a 1031 company sends money directly to a client, and therefore that's where the IRS considers constructive receipt has taken place and the tax is owed. And so in a 1031 exchange, the funds are sent to a 1031 exchange company, and then from there, they're sent to a property. And they go from a property to the 1031 company, and as long as they continue to do that over multiple transactions, no constructive receipt has been taken. Mm-hmm. So likewise, a seller carryback also works the same way. And that if I say, hey, Kevin, I want to buy a deal from you, and let's say it was a $10 million property, and I said, Kevin, and you own it free and clear, I'll give you $1 million down. Would you carry a note for $9 million? And mm-hmm. you say, sure, okay. You carry a note back for $9 million. Well, how much constructive receipt did you take?
Yeah.
Well, you only took $1 million.
Yeah.
Therefore, the $9 million has not been taken. Therefore, you don't owe taxes on the $9 million. Now, let's say another hypothetical scenario came to you and say, hey, Kevin, I'm a really good guy. You trust me. I'm going to do a great job in your community. I'm going to give you $0 down. Would you carry a note for $10 million? And you said, sure, Brett. You probably wouldn't do that in real life because I have no skin in the game. But let's say hypothetically you did that. If I give you $0 down, you carried a note for $10 million, how much constructive receipt did Kevin take?
Yeah, $0.
You took $0, right? And the note is owed you for $10 million. So that's the basis of the structure. And so what we do, though, is our company, Capital Gains Tax Solutions, at close of escrow, when the buyer is ready to buy for $10 million, and Kevin, you're ready to sell for $10 million, we come in right in between, right at close, and we buy it for $10 million from you. We do a regular seller carryback deal with you. We give you $0 down. We send you a note for $10 million, and then we immediately sell it to the cash buyer. By the way, they can get a loan. Doesn't need to be cash. And they deposit the $10 million into the deferred sales trust. So think of it sort of like we're a 1031 company, although we're not. The money is sent to the deferred sales trust. Therefore, Kevin has taken $0 constructive receipt, of any of the cash. Therefore, the tax is still deferred. And since the trust bought it for $10 million, sold it for $10 million, they have zero capital gains tax owed. Does that answer the question? Hopefully
yeah, no, it absolutely does. I think the real benefit of this situation, this scenario, or this tool is now what happens with that money that's in the trust. How can one leverage the seller that sold that carryback? How can he leverage that capital at $10 million using your hypothetical situation? How can they leverage that $10 million and continue to reinvest those gains into additional real estate or whatever it might be? Still tax deferred? Sure,
great question. So let's talk about a few of the benefits, and let's talk about how we can actually go back into real estate and maintain that tax deferral, which is I think what you're getting at there. So the key thing is, remember, this is not a 1031. This is a deferred sales trust. The 1031 came around in the 1980s, and it was almost also taken away. Okay, the deferred sales trust is tax law since the 1920s, completely separate tax law. So the deferred sales trust does not have to follow the 45-180 timelines. It also doesn't have to follow the like kind. Okay, and so when the funds are in the trust, the funds can be directed to wherever the client wants, whether that be to stocks, bonds, and mutual funds of their choosing based upon their risk tolerance. Okay, that they fill out before any of the funds move. Now, once the funds are there, let's say you find a deal tomorrow, Kevin, or day 181, or 5 years from now, you feel like, hey, this marketplace is too high, it's too hot. I'd rather just wait on the sidelines and find a deal when it makes sense. Let's say you find that deal. Well, you, Kevin, you probably do this now with your current deals. You form an LLC, and you're probably the managing member of it, and you're looking for partners. And there are certain partners that come in, and you form a deal. Maybe you do a 90-10 split. Maybe do an 80-20 split. Well, this DST can become a partner of yours. You can choose to partner with your deferred sales trust. So you, Kevin, are the managing member. You form an LLC, and you maybe want to partner with Brett, Joe, and maybe just your deferred sales trust. So you can direct the funds from the deferred sales trust to your LLC, which, think about it, a 1031 is kind of the same thing. The 1031 company sends it to your LLC, which buys the property. So you have not taken constructive receipt. You just partnered with your trust, which also, by the way, gives you a new depreciation schedule, which the 1031 does not. 1031, the depreciation schedule travels, which takes away, eventually, if you own long enough and have done enough 1031 exchanges, it takes away one of the number one benefits of owning real estate, which is the depreciation offset against the income. So that's kind of the short answer of how it works. And the tax attorneys, every particular situation is a little different, but essentially you're just partnering with the trust just like you're partnering with anybody else.
Okay. Give me some, so we're talking about the advantages of a deferred sale trust over a 1031. What will be some instances where a 1031 makes more sense than a deferred sales trust? Because to me, it sounds like it's really advantageous just to go with a deferred sales trust. That way you don't feel pressured into a property unless you absolutely have that replacement property identified and you feel confident that it's going to close. But otherwise, what would be the benefit of a 1031 versus a deferred sales trust?
Sure. So a 1031 exchange, if you can find a deal, and by the way, I still do 1031 exchanges today. My company is called Capital Gains Tax Solutions, and we like to provide all the options and let our clients decide what's best for them and what fits their needs, their external motivation, which is deferring capital gains taxes, and all of their internal motivations, which might be retirement, which might be liquidity, which might be diversification, which might be timing the market, which might be having a new depreciation schedule, which might be estate tax, trying to get some properties outside of their estate before they pass if they're high net worth individuals. But the 1031 is good if you can find a deal. If you can find a deal that makes sense, that cash flows, that it has low fees, right? It's very simple. Everyone knows about it. It's about $750 on average to do a 1031 exchange. You're staying in real estate. My primary love and passion is real estate, so I love commercial real estate. I'm not as big of a fan of stocks, bonds, and mutual funds, although I do have holdings there too. So I think you get to stay in real estate. You have low fees. Everyone knows about the 1031 exchange, and so they're very comfortable with it. Also, you maintain what's called the stepped up basis, which is important, right? So if I can maintain a stepped up basis, when I pass, my property goes to my heirs, and then they can sell and they can get out if they sold at the same time and no additional appreciation. They can get out sort of capital gains tax free. So that's important to note as well. And so I like the 1031. especially in a buyer's market where you feel like you can find deals and add value, makes a whole lot of sense.
Now, you talked about the costs associated with the 1031. Talk to me about deferred sales trust. I mean, we know 1031s they're quite inexpensive, pretty straightforward. How about deferred sales trust? What is the normal cost associated with forming one, but also even maintaining that trust as well?
Yeah, so what are the fees? So there's 3 sets of fees. The first set of fees to the tax attorney, and this includes audit defense, and it also includes the legal and tax structure. The audit defense will cover you for the life of the trust. So if the IRS ever were to audit your particular trust, they will defend you at no additional cost. Their fees are 1.5% on the first $1 million. And then anything above that, 1.25%. Some deals, they get really big. They give another break too. They've done some really large deals. So let's say it was a $3 million deal. The first $1 million would be 1.5%.
Mm-hmm.
The next $2 million that's left over would be 1.25%. Okay, so that's a one-time fee to the tax attorney. The second set of fee is to our company, which is Capital Gains Tax Solutions. We're the trustee, and in order to maintain the integrity of the trust, we must have a third-party unrelated trustee. And we charge about 50 basis points, which is about 0.5%, recurring every year as long as the funds are just invested with a financial advisor.
Mm-hmm.
So 100 basis points would be 1%. 50 basis points is 0.5%.
Mm-hmm.
So we're going to charge about 50 basis points recurring every year as long as the funds are with a financial advisor. So let's talk about financial advisor. They typically charge somewhere between 50 basis points and about a point. Just depends on where the funds are invested and what the client wants. And so all in, if you're just going to be with the financial advisor, it's about 1.5% recurring. Now, as the deals get larger, those fees do drop a little bit for the trustee. We have a break at about $5 million and a break at about $10 million, or we go a little bit lower as well. So let's say the client actually wants to go back into real estate. What happens? Well, again, you can direct the funds whenever he wants into a real estate deal. At that point, the financial advising fee goes to 0 for those amount of funds, but the trustee fee will double. So let's say it was 50 basis points. It now goes to 1 point plus a 1.5% one-time fee to exit. So I know that's a lot, and so I would encourage listeners, if they're interested, to go to our website and just look at it. We have it on the frequently asked questions portion of our website, and we break that down. But also, I also want to note too, we look at capital gains tax as a fee. So the client has a couple options. They can pay the fee to the government, which is gone forever. Let's just take a $5 million example at a $1 million basis, about a $4 million gain. In the state of California, it's about 37% with state, federal, and Medicare tax. And so it's about $1.5 million in tax. So we look at that scenario as, well, client has an option to pay that $1.5 million fee to the government, gone forever, or hopefully move into the Deferred Sales Trust, defer all of that, and then we kick in the rule of 72, which states if we can earn 7% on any given amount and let that 7% compound on top of itself, that amount will double. So in this scenario of $1.5 million in tax, if we can earn 7, let that 7% go on top of 1.5, that 1.5 in 10 years becomes $3 million. Most of our notes that the financial advisor manages, they earn about 8, and after fees, they pay about 6.5. Okay, and then hopefully a client can buy back into a deal at their own timing and maybe make more than that, and therefore hopefully double what they would have paid in capital gains tax up front. So hopefully that makes sense.
Yeah, no, that makes sense. So the beautiful thing about this, I think one of the things I'm extracting from this conversation is that unlike with a 1031, it's got to be a like kind exchange, right? But with this deferred sales trust, you can really diversify. I mean, it doesn't even necessarily have to be back into real estate, correct?
Yes. Yeah, so let's talk about that. So according to the American Bankers Association, about $17 trillion will pass from one generation to the next in the next 20 years. This is known as the baby boomer generation, okay? And it's the largest amount of wealth transfer in the history of the world that we know of. And so what they're facing is wanting to retire, wanting to get out of toilets, trash, and liability, wanting other options, needing liquidity, needing not wanting to go through the highs and lows of like an 08, 010 market, right? They've made their wealth. They've worked hard for 30, 40, sometimes 50 years to get where they're at. And they don't necessarily want to be tied just to one single asset or one single asset class or not have liquidity. So what's neat is you can get out of real estate, all tax deferred, and get diversification. But what's even better is that they have trusted advisors or partners like yourself. They can turn around and invest funds into your next deal as a syndicator. They can partner with someone else. They don't have to do it all themselves. So they can still be in real estate. They can still be tax deferred, but they don't have to worry about the strenuous timelines and feeling pressured or having to overpay for properties that otherwise they wouldn't buy. If it wasn't for the tax, if you think about it, if it was '07 all over again, and you knowing what you know now, and you could sell at the peak and defer taxes, defer all your equity, all tax deferred, and wait for the market to shift. I know that's kind of like playing Monday morning quarterback, but that's what you can do with the Deferred Sales Trust. You can sort of just wait and see and diversify and stay tax deferred and redeploy if and when you want to.
Very interesting. So, with our fund structure, probably at least once every other week, I get an interested party that is in a 1031, entering into a 1031 and wants to see about potentially investing in one of our mobile home park funds. And up until this point in time, I've always turned them away, Brett. And so what you're telling me is that this could be a tool for them. This could be an opportunity for them to essentially sell their property, not do a 1031, but defer their capital gains, but also reinvest into a syndication or a fund type structure. Is that correct?
Absolutely. And there's probably reasons why you don't allow a 1031. And there's probably reasons why when you do sell a deal, you just pay back all of the investors and let them deal with their individual capital gains tax. And likely you've done a good job for them, and they're probably going to go into the next deal. What's great about the Deferred Sales Trust when it comes to flexibility is the fact that we can defer all of those taxes for each individual based upon their own risk tolerance. And we call it the partnership can sever, okay? So we can sever the partnership, and let's say it's Kevin plus 10 other partners, okay? And 5 of them want to do the Deferred Sales Trust. The other 5 just want to cash out. Well, for those 5 that maybe you saved $100,000 or $200,000 in capital gains tax, they're really happy, right? Because they have an extra $200 in their estate. And the next thing for you, you're probably pretty happy too, because they're more likely to send those funds to you, and also they have an extra $200 to send to you. So it becomes a win-win. We define winning as not paying the tax or deferring the tax. We define losing as paying the tax to the government. So hopefully all ships rise with this strategy, because we have an extra, let's say 37%, because it's on average probably 30 to 45% if you include depreciation recapture cost. So the key is, what's the capital gains tax? Would you like it deferred? Where would you like the money? And how would you like it invested? And we can do all of those things.
Okay. So I'm assuming this is probably also a great strategy for those that are entering into a 1031 that have a replacement property selected that, obviously those things can fall apart. I've had a few fall apart on me in the past. Can this be brought into play during, if they've already selected and entered into a 1031, but if it looks like the 1031 is going sideways and it's not going to happen, can you enter into a deferred sales trust simultaneously to ensure it's a backup solution?
Yes, this is the beauty of it. And this is what changed my approach to commercial real estate when I heard about this strategy at Marcus & Millichap about 10 years ago. When my business partner came in and gave this presentation, and he said, look, we can only defer the tax and get them diversified. We'll fast forward. And about a year and a half ago, he said, look, now we can go back into real estate all tax deferred, and we can save a failed 1031 exchange. And I asked my partner, his name's Bob, I said, Bob, well, couldn't you do that before? He says, yeah, we could do it before, but we were financial advisors, and we were trying to, build our business. We weren't trying to, necessarily go back for clients into real estate, but we see the need and we want to provide more value. So we opened up that vehicle. So I said, okay, before I was just passing you leads. Now I'm all in, because this is going to change the way everyone approaches every real estate deal, just like the 1031 exchange did. So I know it's kind of a long answer, but the answer is yes. So at close of escrow, we can do the deferred sales trust, or basically day 46 or day 181. Now it's important to note that we want the 1031 intermediary who we're working with to be familiar and educated with the deferred sales trust, so they're not caught off guard and they don't try to put a halt to it. But yes, we have exchange companies who do this and have done it. And simply is, instead of the funds being directed to a new property or back to the client's personal bank account, they're sent to the Deferred Sales Trust. So yes, day 46 or day 181, we can save a failed 1031 exchange. It also doesn't have to be one of the identification deals. So they can do their 3 deals. Most folks choose the 3-deal method, and they can go for those deals. And we wish you the best to find that. And we also, by the way, those fees that we talked about before, we don't charge any fees unless the deal closes. There's no obligation to do anything with us. Our tax attorneys, CPAs, myself, will do the education. We'll provide the illustrations. The tax attorneys will also do all the legal work without charging any fees unless the deal closes. In fact, we have what's called a conditional agreement that the tax attorney send out to the client. And it basically just states, look, you have no obligation to do it. You don't owe us anything now. But if you close the deal, we'll get paid. So hopefully that answers the question too.
So no upfront hidden costs whatsoever. I mean,
Nope.
to consult with you and your team.
Correct.
Okay, fantastic. Talk to me a little bit about the Delaware Statutory Trust and how that is different than the Deferred Sales Trust.
Right. Great question. And it's good to bring it up because a lot of times those are both known as DSTs and they get confused. So the Delaware Statutory Trust it's sort of like a mutual fund for a 1031 exchange. So there's companies out there, very large companies, very long, strong track records that buy, maybe 2, 3, 4 property portfolio, and they close on the deal and they allow folks to do a 1031 into the property. What's unique about them is typically they're non-recourse debt, so that's good for the client. Obviously, it's a 1031 exchange, so that's nice. And it's real estate, so that's good too. So I've had clients do Delaware Statutory Trust in the past, and it's a good option for some folks depending on their circumstance. Some of the challenges, though, that can be kind of high in fees. You also are giving up really all your control. They decide when they're going to sell. It's typically a 7 to 10 year hold. But you can also go back into another 1031 after that when they do sell. So that is also nice. So really, that's all real estate, and it's 100% real estate, and it's a 1031. So that's good. But the returns could be, right now I think they're averaging around 5% or so, maybe even a little bit lower. And so you just have to compare and contrast and see what's best for the particular client circumstance.
Is that something that your company provides as a service as well?
So my business partner does. Yeah, he's a financial advisor. He's on Forbes top list, and he can do Delaware Statutory Trust. In today's marketplace, we're not one to recommend it because you're really buying in a highly appreciated, seller's market. Mm-hmm. So we would just say, hey, look at the Deferred Sales Trust as an option, diversify, and wait for these, whether it be a REIT or whether it be real estate in 2 or 3 or 4 or 5 years, and buy back in at that point, and maybe get a discount of 20% or 10% from the market peak that we feel like we're in right now.
Got it. Yeah, that makes sense. But I guess where I was going with that question is, your company and your team can act as a one-stop shop as far as advisory services. Yeah,
we're not a 1031 intermediary, but yes, I have my brokerage company too, where I help clients buy and sell mainly apartment buildings, but I've done retail as well. So we can do the 1031 exchanges, but we partner with QIs. We're not a QI, and then of course the Deferred Sales Trust, and then my other partner, who's a part of the estate planning team, CEO, he can do the Delaware Statutory Trust as well. Yeah, so yeah, absolutely, we can do all of them.
I'm assuming the IRS or the IRC Internal Revenue Code has some qualification standards to determine whether or not your sales qualify or not qualified for a Deferred Sales Trust. Can you give us an idea what they look like?
Mm-hmm. Yeah, so let's talk about the audits first. So we've had 14 IRS audits in the 22-year track record. And so 13, all of them are no change audits, all completely clear and clean with the structure itself. And 13 were random audits for the clients that just were high net worth folks, and the audit included looking at the Deferred Sales Trust. And so the last one was a formal audit in 2008. It was a 2-year review. They sent it all back to DC, and they went through everything and talked to clients and really flipped over every rock they could. And they just said, hey, look, you guys are just doing an installment note. You guys are being creative on how you're doing it. But that is there. So we stand on the track record of not only the 14 audits, there are no change audits, the 3,000 plus trusts that have been closed. If I'm in your client's position and I'm looking at this for the first time, here are the questions I would ask. 2 we just answered. How many have been closed? How many IRS audits have you survived? Are there any pending litigation of your structure versus the United States government, or any pending IRS audits going on? Those are all very important, and we would say we're all on the other side of those things now. So does that answer the question? Or no,
it did. Okay. Absolutely. I appreciate that. What else haven't I asked you? I mean, I'm sure there's voids here that I've missed. Mm-hmm. So tell me what else we need to know to better understand this Deferred Sales Trust. Yeah,
we've talked about legality. That's usually the first biggest question. How do we know this thing's legal? The second one is, well, how do I know my funds are protected? Where are these funds held? Well, the funds are held at some of the largest banks in the world, such as Bank of New York Mellon, TD Ameritrade, Charles Schwab, probably a lot of similar banks that maybe your clients have their funds held now with their current financial advisor. Second, they have 24/7 access to view the funds. Third, we have what's called DACA account protection, which is a fancy way of saying they're extra protected and the funds won't move without certain steps in line. And the last one would be the funds only move with the client's signature. So the funds do not move without your signature. So you have all the same protections that you have with us that you would have with your current financial advisor. And so as well, FINRA did a full review as the structure as well. And FINRA oversees financial advisors. Mm-hmm. So kind of like what the DRE is to real estate agents and brokers.
Sure.
That with the DRE is sort of like, or the real estate is sort of like the wild, wild west in comparison to the amount of regulation that FINRA oversees for protection of consumers. So they also reviewed it too and still in business. So that's good. So how do I know my funds are protected? How do I know it's legal? And the last one would be, sounds too good to be true. Why haven't I heard of this? You know? and I would just say, hey, get to know us. Get to know us. Realize that we look at our track record of 3,000 plus case closes. Talk to our clients. If you're a client, you're an individual who maybe owns a business. We've done deals with veterinarians, with dentists, apartment buildings, retail, high-end art, high-end collectibles, anything that really has capital gains tax, we can defer it using the Deferred Sales Trust. So we would say get to know us, but more than that, talk with those who probably are in your shoes or had a lot of the same questions. The next part would be the fact that we want your CPAs, your tax attorneys to give their blessing. We view our role as a kind of a guide to help you in this process. And we realize that you have trusted advisors, be it your tax attorney or CPA, and we call those folks the brain surgeon. And us as a guide in this scenario, we're like the nurse, and we're just going to check you into our brain surgeon before you get surgery. Make sure your brain surgeon talks to our brain surgeon and gets their blessing on the structure and who we are and what we do. We're not asking clients or anyone to be, I'm not a CPA, I'm not a tax attorney, we're not asking you to be that. But we do want their blessing. We want your own. So get their blessing. We'll take it slow, methodical. Also audit defense, right? And also we don't charge unless you close the deal. And also just comparing the 1031 and the Trump tax plan, it was a big challenge. It was almost taken away. And it might be taken out. Who's to say in 3 years a new administration comes in and doesn't get rid of it, right? Because a lot in Congress see it as a tax loophole or just it is a tax loophole, but they see it as they never get their amount because people defer, pass on and give a stepped-up basis. The good news again about the Deferred Sales Trust, it's not a 1031. It's a separate part of the tax code, and they're not even looking at us at this point. Hopefully they won't because we're such a small amount of transactions. So get to know us, get the blessing of your tax attorneys, and then hopefully you decide. You look at the risk versus the reward, and pay the tax or not. Again, we feel like if you pay the tax, it's gone forever. You lose. If you can defer it, we feel like you can win.
What does that initial conversation look like for those that have an interest in learning more? They reach out to you and your company. What does that initial introductory call look like?
Great. Yes. Thanks for asking. The first thing would be go to my website, capitalgainstaxsolutions.com, and just schedule a call with me. If you want a little less formal, you want to just kind of, I guess, poke the bear or see it from the outside, you can attend our no-cost live webinars every Friday at 10 a.m. Pacific Standard Time. As well, go to the website, register for the webinar. We'll send you a link there. Assuming you like, or maybe you have a live deal right now, you can go to our Deferred Sales Trust calculator. Also go to my website. You can access that calculator. That'll give a side-by-side comparison of do the Deferred Sales Trust versus pay the tax. So you have that option. So let's say you put your information in there, you answer 12 questions. Second step, we jump on a conference call with the tax attorney, CPA, myself, and the founder of the estate planning team, and we all discuss and find out if it's a good fit for you and if it's a good scenario. You can also invite your own professionals on that call as well. Assuming you like it, step 3 is we draft the paperwork. You sign the conditional agreement. And I guess step 4 would be you actually close on the transaction. You direct the funds from escrow or from the 1031 company to your trust.
In a typical scenario, what does that time frame look like from beginning to end?
Yeah, our tax attorneys they work really hard and they're really busy, as you can imagine, with this marketplace. They've done deals in as little as 72 hours, but nobody likes to work under that fire drill.
Sure.
Ideally, we're educating people well in advance, even before they're going into escrow, before they're listing the property. We want the Deferred Sales Trust to be as comfortable with you and your professionals as the 1031 is now. And so our role is just a guide to educate, to give you the information, and as early as possible is what we like. But again, we've done deals where they haven't even heard of us until we're with the 1031 company, and then they failed on their 3 properties, and they have no other option, and it's day 175, and they're scrambling, and then we help them out. I'll give a few deal stories too, which also might bring the listeners a little more to life with this strategy. So this also works for high-end primary homes, Kevin, okay? So a traditional home, 250, 500 exclusion if you're married, right? If you lived there 2 of the last 5 years. But for high-end homeowners, beyond that, they do not have a 1031 option. And so we can defer capital gains tax on the sale of high-end primary homes. So as an example, there's a deal in Newport Beach. There's a couple getting a divorce. They owed $6 million above their $500,000 exclusion. They're selling their house for $26 million. And so they have no other option but for the Deferred Sales Trust that we're aware of. And so instead of paying that $6 million to the IRS, they deferred all of it. Another recent deal had to do with 2 veterinarians selling multiple practices and buildings, and for $9.6 million, and they owed about $3.4 million in tax. And so you may or may not know this, but a business does not qualify for a 1031 exchange. So they have no option except for the Deferred Sales Trust that we're aware of. So they did the Deferred Sales Trust. They deferred that 3.4. And then again, the beauty of it is they can go right back into real estate, or if they found another veterinarian practice they want to go into, they can partner and do a vet business as well. And so it works for high-end homes, works for businesses, again, artwork, or you might have owners now who've done seller carrybacks, right? And they have mobile home parks, and they were in the scenario where they said, look, I don't want new toilets, new trash, new liability, new management. I just don't want to pay the tax. So I'll do a seller carryback. I'll delay the hurt for 5 or 10 years, and I know I'll pay it at that point, but at least I get some interest off in the meantime. So those seller carryback notes, we can move to the Deferred Sales Trust. Okay? So we can buy the note and do the DST with seller carryback notes, which is also, again, we would say if you're going to pay the tax, why not defer it and earn interest on it for as long as you want? The other thing to note is it passes on to kids. Okay, their kids are heirs, and they can defer it for as long as they want. They're typically 10-year notes. And at the end of 10 years, they can renew it for another 10 years. And they renew for another 10 years. And then again, pass it on to their kids, and they can continue to do that. Now, at any point, though, they can cash out. They can say, look, I just want to cash out. I want to cash out all of it or some of it, or I want to travel the world. I need a couple $100,000. No problem. We send you that with distribution. Now, you pay the capital gains tax on that amount. Sure. But you have that option is the point.
Can that note be renewed indefinitely for 10-year stints at a time?
Yeah, so at 9 years, 6 months is where we make the calls. Typically, if clients haven't already done that, at any point you can renew the note. But again, most of our notes are 10-year notes, and then yes, you renew it at 9 years, 6 months, and then you do that again, 9 years, 6 months, and you do that again. So the answer is yes. You just keep renewing it.
Okay, fantastic. Well, Brett, this has been a lot of fun, man. I mean, I know, very informative from my side. I hope as well for the listeners. Definitely something that we're going to be implementing and diving into deeper in our very own business. I know that we're going to spend some time with you on the phone here in the future and your team and determine how we might be able to leverage this option and both our personal portfolio as well as our company investments, and how we might be able to help out our investors as well. I mean, it's all about adding value and giving options to folks that would prefer not to pay capital gains.
Exactly. Yeah. The way we say it is when real estate investors or business owners, when they sell, they struggle with capital gains taxes. And so we use the Deferred Sales Trust to give them tax deferral, liquidity, diversification, flexibility to how, when, and where their funds are invested, all tax deferred so they can create and preserve more wealth. So we can help you or anyone else. Please reach out to us. We would love to get to know you and try to help you out.
Okay, fantastic. Well, I'm going to switch gears real quick, and then we're going to wrap up the show here. Brett, I like to enter in what I like to call the golden nugget segment of the show, and you've shared a ton of great information, lots of golden nuggets already, but if you had just one final golden nugget of advice or wisdom that you could leave with our listeners today that may inspire and motivate them as they progress in their real estate investing career, what would that one last final golden nugget be?
So I've read a number of books, and one of my, I call him my, I guess, virtual or book mentor. His name is Jim Rohn, Rohn. He mentioned something that kind of changed my mid-career of personal growth and leadership growth. And so his quote is, "Learn to work harder on yourself than you do on your job. If you work harder on your job, you'll make a living. If you work harder on yourself, you'll make a fortune." And the idea is not about money, although money is a part of it. The idea is the more we become as leaders, and as whether we're fathers, whether we're business owners, whether we're real estate brokers, the more we become as individuals and grow our character and leadership, the more valuable we become to those around us, and how more we can give. And so when I started to shift my focus from, being the best real estate broker, and instead of, hey, how do I grow my leadership and be the best that God's created me to be, I felt like I really succeeded or grew so much more than I was before.
No, I love it. Every little bit of it. I mean, it's kind of like how people talk about working in your business versus on your business, right? Kind of the same idea, working on yourself versus, just being an employee and grind away day in and day out. I mean, work on yourself first and foremost. You are the most important. And I love that. I love Jim Rohn. I've read a lot of his books. In fact, I think I still have a few of the cassette tape programs. He's old school.
Yeah, who would have known, right?
Yeah, for those of you that are...
I'm born in the 80s, but I was listening to Jim Rohn.
I've got some dusty ones on the shelf. I don't have a cassette player anymore, so I can't even listen to them. But
yes.
Well, fantastic, Brett. This has been an absolute blast. Really appreciate you coming on the show. And for those that want to learn more about Brett and his company, you can go visit him at capitalgainstaxsolutions.com. And again, capitalgainstaxsolutions.com. I'm also going to put that into the show notes for you. And Brett, that's all we have, my friend. Really appreciate it. Look forward to staying in touch with you. And I wish you the best, my friend. You take care, okay?
Thanks, Kevin.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.